Hey everyone, summer is finally here, and with the economy reopening, some stocks would benefit more than the others. In this video, I'll discuss 3 stocks that are expected to have a significant revenue increase this summer. The 3 companies will report earnings more or less 1 month from now, and there are a few things that I would watch out for before deciding to add more allocation. As usual, this is not a financial advice. I'm just sharing my personal opinion. Always do your own research before making any investment decision. So the first company is Disney. So reopening is great for Disney as theme parks have been their greatest revenue source in the past. In the most recent quarter, Disney made $2.87 billion operating profit from linear networks that includes domestic and international TV channels like ABC. But the rest of the segment like Disney Parks, Experience and Product actually lost money. So what are the good news? According to Indeed, NBA playoff TV ratings are back to pre-pandemic level. So that's good because many of the games are aired on ESPN network and the final will be aired on ABC. So the other catalysts for Disney are theme park reopening and more people returning to movie theaters. With this year's surging travel demand, Disney ensured that their theme parks are at their best with fireworks and nightly shows returning this month. As for movie theaters, Disney delivered some low-key films including Raya and the Last Dragon earlier this year. They performed relatively well considering the capacity restriction. However, the potentially more successful ones are coming soon like The Black Widow and Jungle Cruise. Is the reopening recovery for Disney already priced in? In some way it does because 2020 was the worst year for the company, but if you look at the 1 year's performance for the stock, it is up more than 44%. Some of this can be attributed to Disney Plus, and there's no doubt that the streaming platform would be a big part of the company's future. Pre-pandemic, however, more than 178 million visited Disney theme park worldwide. So in their next earnings on August 12, it will be interesting to see how much revenue comes from this segment and what are the future outlook. So could this push Disney stock to $200? The potential is there, but I am investing in Disney for the long term. So if the revenue comes in short on expectation, there will be pressure on the share price. But as a long-term investor, I have no doubt that Disney business will recover. So the second company is Airbnb. The company disrupts the traditional hotel industry by providing unique experiences and often at a fraction of a hotel room price. Airbnb is in a perfect position to benefit from the expected surge in travel demand. In fact, with this anticipation, the company is doubling its support agent and roll out changes to improve interaction between hosts and guests. The latest earning results show a promising recovery with $10.3 billion gross booking value, a 52% increase compared to last year. So this didn't translate into a higher revenue increase, but it's important to note that the booking is not recognized as revenue if the trip is not scheduled to happen in the same quarter. So with COVID restriction at ease, I expect a stronger revenue growth for the remainder of the year. In terms of valuation, Airbnb is expensive and there are a few risks to keep in mind. However, I won't discuss them in this video. If you're interested for more detail, feel free to check out my previous video on Airbnb. So there are a few sectors like banking that would benefit from reopening and even thrive during inflation. Companies like BOA and JP Morgan are interesting, but at the same time, I'm more bullish on fintech companies like PayPal and Square. The third company is neither of those. To mix things a bit, especially if you are considering diversifying outside of growth stock, I chose Home Depot instead. The company has been growing single digit for years, but the pandemic has pushed that growth to double digit in the last few quarters, with more people are spending on home improvement. In a post-pandemic world, many analysts expect that their earnings would eventually return to single digit. However, although some states in the US are easing business restrictions, people are still maintaining their spending habits during the pandemic. The summer quarters are also typically the best ones of the year as people purchase more from their outdoor space. In addition, in their last earnings call, the company also mentioned that as more people are vaccinated and the spread of COVID is declining, people are increasing home improvement projects requiring professional service. Eventually, the revenue growth would decrease, but in my opinion, some of the changes caused by the pandemic are going to stick around. The company has held back on opening new stores and instead focused on in-store improvement, e-commerce, and returning capital to shareholders in terms of dividends and share buybacks. So they call this strategy One Home Depot, and they have taken this to the next level recently with one supply chain strategy with a target of building the most efficient delivery network. So the company currently has a 2% dividend yield, and they have increased their dividend by 10% or more since 2011, while the payout ratio is still managed very well at just under 39%. So the number of shares outstanding have fallen significantly, which also helped boost the earning per share growth for the company. The stock is fairly valued in my opinion with a 23 PE ratio, which is still half of the 46 average PE ratio for S&P 500 companies. While I don't have it yet in my portfolio, I'm considering starting a small position. Anyway, which reopening stocks are you investing in? Feel free to drop a comment down below, and if you think that this video is helpful, feel free to like and subscribe to the channel because this will help others finding this video easier. Thank you for watching and see you next time.